Picture this. It is December 24th, 2025, Christmas Eve. Most of the world is focused on cheap wine, overpriced gifts, and the illusion of holiday peace. But inside the glass towers of Manhattan and the cold marble halls of London, the air is thick with the scent of unwashed sweat and pure, unadulterated panic. The high-priced suits at J.P. Morgan and Goldman Sachs are not looking at their bonus checks this year. They are staring at a screen, and that screen is screaming a single number at them: $67.25. While you were worrying about your electricity bill, the most dangerous mathematical trap in financial history just snapped shut. On Friday, December 13th at exactly 3:47 p.m., silver crossed the $67 mark. In that moment, a silent kill switch was flipped. This was not a market move. It was an execution. We are talking about 8 major banks, 8 institutions that think they own the world. They are currently trapped in a short position of 421 million ounces of silver that they do not have. They sold something they did not own, betting that you would stay poor and they would stay powerful. But the math just broke. By the time the eggnog is served, these banks have a choice: find $891 billion in cash collateral, or watch the entire global banking system liquefy before the new year. This is not a conspiracy theory. This is not a prediction. This is a countdown. We are currently in a 72-hour window that will determine if your bank account exists by January. Most people are blind to this because they are looking at the shiny surface. They do not see the rule changes. They do not see the empty vaults. And they certainly do not see the ghosts of 2008 coming back for a second helping. Welcome to the end of the paper illusion. Grab a seat, because the next 25 minutes will explain exactly why the elites are terrified of a piece of gray metal, and why $67 is the number that finally breaks the back of the global elite. The clock started on Friday, and as of right now, there are only 48 hours left until the first domino falls. Now let us talk about the invisible rope that is currently tightening around the necks of the world's biggest bankers. Most people think the price of silver goes up and down because of supply and demand. That's cute. That's what they teach you in freshman economics before they rob you blind in the real world. In reality, the price is managed by a thick book of rules that nobody reads. But in March 2023, the Chicago Mercantile Exchange, or COMEX, added a little something called Rule 4.07b. They called it the Enhanced Margin Liquidation Protocol. It sounds like a medical sedative designed to put you to sleep, and that was exactly the point. Hidden deep in subsection 3 of the rulebook, it states that if a systemically important participant, which is just a fancy word for a bank too big to fail, sees a price move exceeding 285% from their entry point, they must post 100% cash collateral within 72 business hours. Here's the translation for people who actually work for a living. Between 2020 and 2023, these 8 banks shorted massive amounts of silver at an average price of $22.40 per ounce. They were arrogant. They thought they could suppress the price forever by dumping infinite amounts of paper silver on the market. But the math of Rule 4.07b has no mercy. When you take their entry price of $22.40 and factor in their massive leverage ratio of 3.2 to 1, the magic number becomes $67.25. That's the kill switch. On December 13th, when silver hit $67.30, the trap was sprung. The irony here is enough to make a gargoyle laugh. This rule was actually created to protect the exchange. After the Wall Street silver movement nearly broke the COMEX in 2020, the regulators panicked. They wanted a system that would force big players to liquidate early before a short squeeze could destroy the entire exchange. They built a cage to keep the retail investors out, but they forgot to check if the banks were already inside. Now, the very rule designed to prevent a squeeze is the one guaranteeing it. The banks are not just being asked for more money, they are being forced to buy, and they have to buy at exactly the same time. We're looking at 8 trapped rats, all trying to fit through a door that is only 1 inch wide. These banks are sitting on positions that are mathematically impossible to escape. They can't print more silver, they can't change the laws of physics, and as of this moment, the 72-hour clock is ticking toward a mandatory liquidation that will make the nickel squeeze of 2022 look like a playground fight. Let us pull back the curtain and look at the faces of the geniuses who managed to lose billions on a metal used in solar panels and silverware. We are told these are the smartest guys in the room. They have the best algorithms, the fastest computers, and the most expensive lobbyists money can buy. Yet, here they are, caught with their pants down in a mathematical vice. According to the December 2025 CFTC Bank Participation Report, the damage is not just bad, it is catastrophic. Leading the pack of losers is J.P. Morgan Chase. They are currently holding 97.3 million ounces of silver in short positions. At $67 an ounce, their losses stand at $4.350 billion. Next up is HSBC Holdings, drowning in a short position of 78.6 million ounces, which translates to a $3.5 billion hole in their balance sheet. Then we have Scotiabank with 62.1 million ounces short, sitting $2.7 billion underwater. BNP Paribas is not far behind, holding 51.4 million ounces with losses of $2.2 billion. UBS Group, the giants of Swiss banking, have 44.8 million ounces short for a $2 billion loss. Deutsche Bank, which seems to find every financial landmine in existence, is carrying 39.2 million ounces, putting them $1.7 billion in the red. Citigroup holds 28.7 million ounces with $1.2 billion in losses. And finally, the vampire squid itself, Goldman Sachs, is short 18.9 million ounces with an $843 million loss. Add it all up, and you get 421 million ounces of short positions with total current losses of $18.79 billion. But wait, it gets funnier. These are not just isolated bets. These short positions are used as hedges for a massive derivative complex worth $891 billion. If these silver shorts fail, the entire plumbing of the global financial system gets clogged with toxic waste. We are talking about pension funds, sovereign wealth funds, and commodity index funds, all tied to the same sinking ship. For years, these 8 banks have treated the silver market like their personal ATM. They used a simple, brutal tactic. Every time silver tried to break higher, they would dump massive amounts of paper contracts on a Friday afternoon to crash the price. It was a game of musical chairs where they owned the music and all the chairs. But on December 13th, the music stopped and they realized the chairs had been sold for scrap metal. These institutions are no longer the hunters, they are the prey. They are systemically important, which is just a polite way of saying they are too fat to run and too bloated to hide. In the next part, we will see why they can't just buy their way out of this mess, because the vaults they claim are full are actually as empty as a politician's promise. If you ever want to see a billionaire cry, ask him to show you the actual silver he claims to own. In the world of high finance, silver exists in 2 parallel universes. The first is the digital world, where banks trade trillions of paper ounces that do not exist. The second is the physical world, where actual bars of metal sit in cold, dark vaults. The problem for our 8 trapped rats is that the digital world just collided with reality, and reality is looking very empty. Let us look at the numbers inside the COMEX vaults as of December 18, 2025. You need to understand the difference between registered and eligible silver. Registered silver is the only metal available to delivery. It's the inventory on the shelf. Eligible silver is just metal being stored for someone else. It's like a car in a parking garage. You can look at it, but you can't drive it to settle your debts. Back in January 2024, the COMEX had over 329 million ounces of registered silver. As of yesterday, that number has collapsed to 47.2 million ounces. That's an 86% decline in less than 2 years. To put that in perspective, this is the lowest level of physical silver in the vaults since 1975. The last time the cupboards were this bare, gasoline cost 57 cents, and the Sony Betamax was cutting-edge technology. The math here is terrifying for the banks. They need to cover 421 million ounces of short positions, but there are only 47 million ounces available to buy. That means there is nearly 9 times more demand than there is physical supply. In any other industry, this would be called a total collapse. In banking, they call it a liquidity challenge. Why is the silver gone? Because the world finally realized that you can't build a green revolution out of paper contracts. China's solar panel industry alone is consuming 890 million ounces a year. The massive AI data center build-out is devouring another 340 million ounces for specialized cooling and high-speed circuitry. India is importing record amounts of physical bullion. The global mining industry is only producing about 1 billion ounces a year. We are in a structural deficit of over 1.1 billion ounces annually. You can't just dig faster. It takes 10 years to start a new silver mine. You can't print silver in a basement, and you certainly can't use a digital contract to solder a circuit board for an AI server. The banks are trying to fight a forest fire with a water gun filled with ink. They have spent decades suppressing the price of silver to keep the dollar looking strong, but they ran out of the one thing they can't faking, the physical metal itself. The vaults are bleeding out at nearly 850,000 ounces every single day. At this pace, the registered vaults hit zero by February. The illusion is over, the magicians are out of tricks, and the audience is starting to demand their money back. If you still think your silver ETF is the same as owning silver, I have a bridge in Brooklyn and a crypto coin named after a dog to sell you. We are witnessing the largest shell game in history, and it is all being documented in the fine print that nobody reads. Let us look at the smoking gun, the iShares Silver Trust, ticker symbol SLV. Between December 1st and December 18th, 2025, investors poured nearly $5 billion into SLV. At $67 an ounce, the fund should have gone out and bought over 73 million ounces of actual silver. But their own holdings report shows they only added 41 million ounces. Where is the other 32 million ounces? It does not exist. Buried on page 83 of their prospectus amendment, they admit the truth. They are holding nearly 20% of investor assets in unallocated accounts. Translation, they are giving you a receipt for silver that the banks have promised to find later. This is exactly how the money market funds failed in 2008. It is a Ponzi scheme with a shiny logo. But while the retail public is being fed paper promises, the smart money is sprinting for the exits. Have you checked what Michael Burry is doing lately? Yes, the man who saw the 2008 housing crash before anyone else. In his latest filings, Burry sold 100% of his silver mining stocks and 100% of his SLV position. He did not sell because he hates silver. He sold because he hates paper lies. He moved his entire position into PSLV, the Sprott Physical Silver Trust. Why? Because Sprott actually audits their bars and does not issue a single share unless the metal is sitting in a vault in Canada. Burry also jacked up his cash position to 31%. He is not just waiting for silver to go up, he's waiting for the banks to fail so he can buy their assets for pennies on the dollar. Ray Dalio and Paul Tudor Jones are doing the exact same thing. They are dumping commodity index funds and loading up on physical metal. Dalio recently warned that we are seeing counterparty risk that looks exactly like the lead-up to the Lehman Brothers collapse. He said it himself, central banks can print dollars, but they cannot print silver. When the largest hedge fund managers in the world stop buying the bank's paper and start demanding physical delivery, the game is over. They know the vaults are empty. They know the ETFs are backed by nothing but hot air and bank IOUs. They are positioned for a systemic break where the price of paper silver goes to zero, while the price of physical silver goes to the moon. You are being lied to by the mainstream media and the big brokerages because they need you to stay in the burning building so they can use you as a human shield. The smart money has already left. They have moved to the high ground of physical ownership, and as the fire reaches the derivative floor, the exit door for everyone else is about to be locked. Now we come to the final act of this tragedy. Mark your calendar for January 20th, 2026. This is not a guess. This is the expiration date of CFTC Emergency Order 250847. This is the day the government's hall pass for the big banks expires and the regulatory trap snaps shut on their necks. When the sun rises on January 20th, the 8 trapped banks will have exactly 48 hours to comply with normal position limits. They are currently over the limit by 383 million ounces. They need to buy nearly 8 times more silver than exists in the COMEX malts. This is not just a squeeze, this is a total atmospheric collapse of the silver market. History does not repeat, but it certainly rhymes with a vengeance. In March 2022, when nickel had a similar shortage ratio, the price exploded by 900% in 3 days. In October 2008, Volkswagen shares went up 11 times in 48 hours. If we apply that same math to silver, starting from $67, we're looking at a target range between $680 and $920 per ounce by early February. But this will move faster than 2008. Why? Because the crisis is concentrated. In the Lehman collapse, the poison was spread across hundreds of banks. In the silver crisis, it is concentrated in 8 institutions. Concentration means speed. It took Lehman 11 days to freeze the system. Silver could do it in 9. Here's how the next few weeks likely play out. By January 22nd, the banks will realize the metal does not exist at any price. Silver will gap up to $180 overnight. By January 26th, the major ETFs will freeze redemptions, locking you out of your own money. By the end of the month, the Federal Reserve will be forced to announce a silver market stabilization facility. That's just a fancy term for a taxpayer-funded bailout of the bank's silver gambling debt. They will try to settle the contracts in cash at $400 or $500 an ounce because they can't give you the metal. But by then, the price for actual physical silver in your hand will have disconnected from the screen price entirely. So what do? If you're still holding paper silver or bank-backed ETFs after January 15th, you're essentially donating your wealth to the bank's legal defense fund. Sell the paper and find the metal. If you can't find silver, look at mining stocks as a secondary play, but be prepared for the exchanges to freeze trading just like they did with GameStop. The decision window is closing. You have roughly 30 days until the event horizon. After January 20th, it's no longer about the price you pay, it's about whether or not you can find anyone willing to sell. The elites are not scared of silver because it is a metal. They are scared because they can't control it, they can't print it, and they finally ran out of it. The kill switch was flipped on December 13th. The countdown is running. The numbers don't lie, but the banks do. Don't wait for the evening news to tell you the vaults are empty. By then, the only thing left will be the silence of a broken system. I will see you on the other side.